So to allocate manufacturing overhead, we can use a predetermined factory overhead rate. So to calculate a predetermined overhead rate, we will take the estimated factory overhead cost, which is management decides at the beginning of the period, we think we're going to incur $100,000 of factory overhead. It's an estimate. Versus the estimated activity base, which would be something like direct labor hours, machine hours, or something like that. And that's how we get our estimate. So let's look at our Quixote guitars. So let's just say we estimate at the beginning of the year, we think we're going to have $50,000 in total factory overhead. In our base, we estimate to be 10,000 direct labor hours. So our predetermined factory overhead rate comes out to $5 per direct labor hour. So if a job takes 10 labor hours, then we would allocate $50 of overhead to that job using the predetermined factory overhead rate. Why are we using the predetermined rate? Why don't we just allocate actuals? Well, this way we get timely information because we can use the predetermined rate to apply the overhead at any time. Where if we used actuals, we'd have to wait to the end of the period to allocate the overhead. Which it's more accurate to wait to the end of the period, it's just not timely because you have to wait. And some companies use what's called activity-based costing, ABC, which uses multiple predetermined rates and multiple activities, and we'll look at that later. So we're going to apply some overhead based on our job 71 and job 72. So we were told that our overhead predetermined allocation rate is $5 per direct labor hour. So on job 71, we had 350 direct labor hours. So we take the 350 times $5. That means we get $1,750 of factory overhead for job 71. We do the same thing for job 72, 500 hours times $5. And our factory overhead using the predetermined rate is $2,500. So now for job 71 and 72, we have our direct materials, direct labor, and factory overhead calculated. And now to actually record the applied overhead, we're going to reduce our factory overhead account by $4,250. And then we're going to increase our work in process account, $4,250, just moving it from one bucket to another. So what if the actual costs incurred are different than the applied overhead using the predetermined rate? Well, we will have to make an adjustment. So over-applied overhead is when the amount applied using the predetermined rate exceeds the actual costs. Underapplied is the opposite. So the amount applied is less than what actually comes through as costs and overhead. And if it's large over and under, you need to investigate it. You might need to change your predetermined overhead rate going forward to fix the under or over application if it's a large number. But it's expected there's going to be some difference. So at the end of the balance of factory overhead, the actual cost versus applied, it's carried forward from month to month. So you can have that balance month to month, but at the end of the year, you have to close it out. So if your factory overhead has a positive balance or a negative balance, you have to close it out to zero at the end of the year. The common approach is to move it to cost of goods sold. So in this case, we're imagining that we have a $150 balance in our factory overhead account. We underapplied using our predetermined rate. So we reduce factory overhead asset to bring it to zero, and then we bring the $150 to cost of goods sold as an expense on our income statement, which reduces retained earnings. So if we look at our job cost sheets, job 71 and 72, we can reconcile those down to the work in process account. So if we add up job 71 and 72 for beginning balance, direct materials, direct labor, and overhead, we get $31,250. Job 71 was completed, So job 71 gets moved out of work in process and into finished goods. So we take the 31,250 less the 10,250 from job 71 because it went to finished goods. Our ending balance in work in process is 21,000. So when job 71 was completed, what we're going to do is we're going to reduce our work in process, 10,250 that we saw in the previous slide, and we're going to increase our finished goods asset by 10,250. So we're moving it from one bucket to another. So if we look at our finished goods account, we see job order 71, 20 guitars, 10,250 we talked about. So this just reconciles what finished goods we have on hand and ready for sale. So if we look at December 1st, we had 40 guitars finished. And then we go down to December 31st, that's our job 71. So we added 20 guitars at 10,250, and our cost per guitar was $512.50. So manufacturing, when you actually sell something, it's treated like merchandise. So say we sold $34,000 of guitars on account. So we increase our accounts receivable $34,000, and then the value of those guitars on our finished goods inventory was $20,000. So we reduce our finished goods inventory by $20,000. On our income statement, we recognize $34,000 of sales revenue, $20,000 of cost of goods sold, which nets out an increase of $14,000 in retained earnings. So let's look at this in two transactions. So for the actual sale, we increase accounts receivable and increase sales revenue on the income statement. And then for the inventory cost of goods sold, we reduce finished goods inventory $20,000 and recognize cost of goods sold for $20,000. So it's actually two transactions happening here. So what we looked at before was product cost. Now we're going to look at period cost. Cost used to generate revenue during the period, not involved with manufacturing. These aren't product costs. So the two categories we typically see are selling expenses and administrative expenses. Selling expenses would be marketing and just delivering the product to the customers. And administrative expense would be administration of the business. So that'd be like your accounting department, administrative staff. So we can see a few examples here. So selling expense, advertising, sales, salaries, commissions, selling the product. Administrative, office salaries, your accountants, your administrative staff, office supplies. And depreciation on office buildings and equipment. Depreciation on the factory would be a product cost. Office buildings would go towards administrative costs. So if we look at the accounting, we have sales salaries for $2,000 and office salaries for $1,500. We recognize $3,500 in salaries payable because we did the work. They did work for us. We haven't written them a paycheck yet. $3,500. Then on our income statement, we have office salaries expense, sales salaries expense, and we know expenses reduce retained earnings on the balance sheet. So here's the summary of the cost flows. So you can see in A, we bought the materials, so we increased our materials inventory. In B, materials were requisitioned for the jobs. So transaction B, somebody went to the storeroom, went and got $13,000 worth of materials out to use for jobs. You look at transaction C, labor that was used in the production of jobs. So that was our direct labor from our wages payable to our work in process. If you look at D, we incurred some of the overhead we incurred. Not the overhead we applied, but the actual costs of overhead we incurred. And then in E, you see we move applied overhead from the factory overhead account to the work in process account using our predetermined overhead rate. Transaction F, we close the under-applied inventory overhead account to cost of goods sold. So remember, we had to get that overhead account to zero, so we had to move that 150 from factory overhead to cost of goods sold. Number G, we finished job 71, so we moved the 10,250 associated with job 71 from work in process to finished goods. Transaction H, we sold 40 units of the jazz guitars. And then in I, we show the cost of the 40 units of the jazz guitars in cost from finished goods to cost of goods sold. If you understand this slide and how all of this works, you're in pretty good shape for this chapter. If we look at our income statement, we sold 34,000 worth of guitars. Our cost of goods sold was 20,000 for the guitars plus the 150 of the under-applied overhead. Then we subtract our selling and administrative expenses. We get income from operations of $10,350 for Quixote guitars.